A few days ago, I went to the New York Stock Exchange, stood on the balcony, and had a great discussion with Peter Tuchman. You probably know him as the Einstein of Wall Street, the most known figure and face. Every time a picture is being taken in the New York Stock Exchange, you can see his face because he looks very much like the Einstein of Wall Street. We talked about day trading. We talked about the volatility of the markets. We talked about everything that has changed in 2022. And I have the pleasure and the opportunity to share that conversation with you on this channel. Are you ready for it? Let's go! Hi everyone! Great having you.
What's up?
Hey, and we've got Peter again. Peter was on our show about a year ago during the COVID, right, Peter? When we needed masks and COVID tests.
Yep.
And we're back here on the floor.
Yep.
I'll add pictures later.
Yeah.
And I have a few questions for you.
Absolutely.
First of all, how have you been in the last year?
You know what? It's been a crazy year. You know, look, life is challenging, right? We're all trying to come out of COVID and get our lives back together, right? And it's still crazy town. You know, every time you think things are going to sort of get normal again, something else happens, another shoe falls. But let's focus on the market because the market has been 2022. I think it was probably 2021 when you saw me last. 2022 has been the most spectacular in so many ways from a volatility point of view. We have literally not had one day where the market has less than 0.5% move and as much as 7, 8, 9% move intraday. And that is clearly, I mean, I've been here for 137 years. You guys know that, right? I went to high school with Alexander Hamilton. I've seen it all. I've seen every movie. I didn't see the crash of 29. I was out that day, but surely the crash of 87, 2000 bubble, 2007 financial crisis, and the COVID crisis. So I've seen every one of the movies, and I've never seen the movie of 2022. There's no playbook for it. It's never happened before. So that kind of volatility, that kind of look, if you think of the market as sort of a huge puzzle, right? And then all the different components of that puzzle that affect the way the market goes up and down, this is like a 1,000-piece puzzle, right? In the past, it was 100, 200, 300-piece puzzle. This year, 2022, has been a 1,000-piece puzzle between coming out of COVID, the supply chain issues, inflation, possible recession, wild moves in the yield curve, obviously the oil thing, the wild card being the war in Ukraine. That's been an absolutely crazy thing. Then the Fed's intervention into the marketplace, starting to raise rates, the market being off some points, 70, 80% in some of these incredible stocks. And then the attempt at trying to figure out how to get out of 2022. And so that's where we are today, right? It's beginning of November, beginning of December, the most volatile year in history. So let's kind of break it down.
So, you know, it's strange because, you know, we're retail investors, right? But let's start actually from the big one. I am, yeah. Let's start from the big guys. Let's start from the smart money. Not the smart money, the big money.
Okay.
And you work for them, right? You move their money.
Correct.
How are they dealing with this kind of situation? Because even for them, you know, let's say I'm a portfolio manager. Let's say I manage hundreds of millions of dollars and I own a few tech stocks. Every earnings report can be a plus minus 20% hit on my portfolio. So it's not anymore pocket change. It really moves the needle. How are they thinking? And how are you dealing with them probably calling you in the middle of the night?
Well, you know, I mean, that's not really my situation, but I can help you analyze in response to your question and answer it the best way possible. I've got to call in, you know, look, we've got the big hedge fund guys, right? And I think the world and the dynamic has changed in such a way, I try and analyze and learn from what I see around me. And let's talk about it. January 2022, Bill Ackman, right, one of the largest hedge fund managers in the world, took a position from opinion, right? He obviously, he runs billions of dollars, and his decision-making obviously comes from a lot of intense breakdown and forensic analysis and fundamentals and technicals of a company because he's investing big people's money. And in January 2022, he took a massive position in Netflix at around $700.
Yeah,
right now it's around $700. And I know you look, and 3 months later, 3.5 months later, he sold his position. He's had positions in stocks that have gone against him, way bigger than this loss. But he's never taken those losses. He held on and ended up, surviving and becoming profitable in a lot of those trades. Just to call like Herbalife and whatnot when he went up against Carl Icahn. He, after 3.5 months in a very, very painful trade, he took a haircut and a loss of $430 million. Now, look, that is major, right? That is a whale, a incredibly bright gentleman, one of the biggest players in the game, realizing I've made a bad decision. Obviously, this is painful, but I got to get out of it and move on. Whether it was a good decision to take that loss at the time or not, but I mean, in respect to your question, how are the big guys dealing with it? That on an intraday basis, you can have actual P&L movements that are 1, 2, 10, 15, 20% moves in a stock. We're seeing, I always joke about it when we talk about teaching our young retail trading community and not getting into stocks, not getting into trades in advance of the CPI number, the Fed minutes, earnings reports and whatnot. Be reactive and not proactive, because you can be right for $1 or wrong for $50. We're seeing moves on earnings. We're seeing moves. I will call it up. If anybody here has been watching the CPI number, and all eyes have been on the CPI number, the last one, look, the CPI number basically it designates whether inflation is in check or whether it's getting worse or it's getting better, right? And all eyes have been on that because we're desperately trying to get the Federal Reserve, if the CPI number were to come down and we get a little bit of a handle on inflation, then we're going to get a bit of a pullback or a retracement or a pivot by the Federal Reserve. So all eyes were on that last number. It was 3 weeks ago. Everyone, obviously, look, pre-market, okay, the S&P 500 was down 40 handles, meaning that everyone thought that the inflation number, we weren't getting a handle on it, that it was going to be hot, and that all this aggressive 75 basis point moves by the Federal Reserve were not working, and that we were off to a really bad end to the year. And so they had sold the market pre-release of the information.
Because they wanted to be proactive, right?
They wanted to be right, and they wanted to be the first one on the train, and they were making a bet about their opinion. There was no news out. There was no information. They decided that this was going to be bad, and they sold the market down 40 handles in advance of the release. The release came out. It was 0.2% better than expected, and the market went up 1,000 points. The S&P retraced the 40 it was down and went up another 100. That is insane. That is absolutely wild. Everybody who made that negative bet blew up their trading account. I'm sorry, I don't care who you were. Small retail investor, institutional investor, massive high wealth trader. You blew up your account. You were sitting out on the corner smoking Lucky Strikes and drinking bourbon because you had blown up your account on a proactive decision that was absolutely could not have been worse. So in response to what you asked me is, how do the big guys, how do the retail guys, how do the major whales and institutions look on an intraday basis when you could be right for 1% or wrong for 30%? How do they deal with that? And it's look, I trade for a hedge fund. My company trades for a hedge fund. It's one of my customers, and we see intraday P&L moves. Look, the other day, Jay Powell was talking at Brookings Institute.
Yeah.
Nobody knew really what he was going to say.
And he didn't say anything new.
And he didn't say it. Well, no, he did say. He did say one thing. He was talking a little bit out of both sides of his mouth, as he often does, and I'm a fan, so nothing against Jay Powell, but it was like, okay, so Dad is telling us we're sort of still on track. The economy's not that much better. The labor market's this, a lot of different pieces of the puzzle, dropping out some things, but he did say that it looks like the way inflation is heading, that we may be able to pull back, and maybe a 50 basis point move for December is in the works. He didn't say it exactly that way, but he did say that sooner than later, probably as early as December, we may see a bit of a pullback in our aggressiveness. And the market went up 1,300 points, even bigger than the CPI number. So if you were right, you made a bunch of money. But if you were wrong, you were blowing up your account. So it's not a matter of
But why is that happening? Why are these fluctuations happening? I don't think it ever happened when it wasn't a crash. Right? COVID crash, fine, things drop.
Okay.
But on the report, on Powell speaking on something, the market goes crazy. What has changed behind the scenes? Because you're here behind the scenes. You know, we look at our charts. We're not behind the scenes. We're behind the charts, maybe. But what has changed? How come these fluctuations?
Correct.
Who got involved?
It's a great question. And in the beginning of January 2022, when this wild volatility started, I was trying to analyze it. What has changed? Why? Maybe these are not the rule, but the exception to the rule. These wild moves that we're seeing, down 1%, up 3%, down 1,000 points, a bear market at 11 o'clock. After lunch, we're in a bull market. Moves that used to take generational periods of time are happening now intraday. That is absolutely insane. That's why I keep talking. This is a pivotal and generational time for people to learn how to trade the market. Because, look, I always use this funny analogy. If I wanted to be a really great fireman, I wouldn't move to Iowa, where there's 4 fires a year. Nothing against Iowa. I would want to be in New York City, where my feet are in the fire, as it were, not to use a pun, on a daily basis. So if you're a student of the market, to have a market like the 70s and 80s, where things were kind of quiet and flatlining and base trade type of activity, you want to be in a market where the candlesticks are wild and crazy, and the moving averages are $3 or $4 away from the moving average and all that stuff. That is a great time to learn how to trade the market. So getting back to your question, I thought it was an exception to the rule when we started seeing this 1, 2, 3, 4, 5% volatility, but it's actually happened every day in 2022. Yeah. We're here in December, and literally, as I said, there has not been one day, right? In fact, 2 days ago, I actually made a point of it in my after work video that the Dow was up 3 points and the S&P was down 0.2 of a point. Yeah. And that was the slowest or quietest deviation of a day we've seen in the whole year. We've had nothing less than at least 0.5% and as much as 9% intraday moves in this market. Why is it happening? It's really hard to understand. Is it a new player in the game? Is it the retail investor? Is it big money? Is it fast money going in and out? Is it algorithmic trading? Is it sort of algos that are tied to social media that when they see a tweet that they react? Is it the lack of deep, dense liquidity in the marketplace that markets are actually reading? When a swoop comes in on the buy side, the sellers disappear, and the same thing when the sellers come into the market, the buyers disappear. I think it's a function of all of that. Right? Is it big institutions trying to position themselves for these kind of moves so that when you're wrong, I kind of think, as I'm trying to analyzing while you ask me the question, I kind of think that it's probably a bunch of all of these things, but I really think it's a matter of the fact that people, when they make a decision, and a lot of these big hedge funds and a lot of the big institutions make decisions based on fundamentals and whatnot. And they have a lot of vested interest in it being right, because nobody wants to hear at the end of the year they were down 30%. So my gut is that they're basically, when they're right, they're in the position and they're going to start taking profits on the way up. It's more like the guys who used to be long-term investable traders are now turned into a little bit of a different fast money game. Because like Bill Ackman. Bill Ackman has been in trades way worse and way longer and never got out of the trade. This gentleman spent $1 billion probably on Netflix at 700. 3 months later, he goes, you know what? I'm wrong. I'm taking my oats out of here, and I'm leaving the party, right, for $430 million loss. So I kind of think that you're seeing people, like when they want to get in, they get in a swath of buy orders and market orders. When they want to get out, whether they're right or wrong, taking a profit or just losing, they get out. And so you're seeing these swaths of billions of dollars come in the market and billions of dollars coming out. So it's kind of like the longer term guys are now become a little bit of fast money. It's just my opinion. I'm just trying to understand it. Is it the retail trader that's look, we know the retail trader came into the meme stocks and were participating in the wild moves from GameStop from 2 to 483 and back to 152. It could be a little of that too. It could be a little bit of what I just described, and it's probably a lot of all of those things.
Yeah, so that's very interesting, and I think that takes us to the next kind of question, because you, in the last, I think since last we spoke, you kind of took the whole trading and educating people on trading to the next level, right?
Correct.
Whether it's on your TikTok, whether it's on Instagram, on Reels, and you have right now a course with
we have an academy with David Green.
Exactly. So, first of all, before you kind of share with everyone what the academy, what was the thought behind that? Is it the markets, or you say, you know what, everyone needs to know how to trade candles, and it's, I would have started 10 years ago if I had the right opportunity.
Okay, so David Green, who I met here in 1985, we started on the floor together. He went on to become a market maker for Spear Leads, ended up getting, or for Goldman Sachs, and got bought out at the age of 38. He retired. And he then went on to trade for himself and was not that successful originally, and realized if I don't really learn how to trade, as a trader on the floor and a market maker on the floor, you have all the orders in your hands, so it's a lot easier to manipulate market, to manipulate your way into a profitable trade. When you're off the floor, as you probably all know, and you're not privy to some of the information that we have, not inside information, just information, right, then it's harder to trade, right? You must be seeing that, and I see the retail community struggling. So he went on and he realized, you know what, I'm going to start teaching myself how to trade, and in turn become a teacher of other people. He's been teaching people for 15 years. When COVID came along, he and I saw an opportunity. When TD Ameritrade said we've got 40 million new traders coming into the market with Webull and with Robinhood and all these free trading apps, we thought, how amazing. What an amazing thing. Everyone's been invited to this party. 40 million new people are trading the market. Let's see how they do. Well, obviously, a few people made a bunch of money trading the meme stock, but we saw at the end of that, very quickly, when the market stopped doing nothing but go up, that it was a very challenging market to trade. And so we thought, what an amazing opportunity to suddenly have a pool of 40 million new people who obviously had tried to make money, were not given the memo that markets don't just go up, that markets are volatile, that you need to learn how to hit singles and doubles. The technical analysis is way more powerful in a volatile market than fundamental analysis. Why not take this opportunity to teach them? So we built an academy called Wall Street Global Trading Academy, WSGTA. There's a link in my bio. We have
add it on the description.
Yeah. It's 9 hours, 21 videos, plus 100 hours of archives. And we've created this amazing community of a few thousand people globally who we've been teaching for the last 2 years. What we saw is, which has changed over the last year, is we've seen that it's become harder and harder as the market, as we've just described. 2022 is clearly the most volatile market we've ever seen in our lives. These moves of a stock going up $1 and down 50, and then up 20 and down 30, intraday, intra-hour, right, is so dangerous. And we've seen people, the psychology of day trading, we're talking day trading, we're not talking investing. Day trading is absolutely a spectacular thing to learn, but you need to know the rules.
So we talked about the academy. Before we go to day trading, I want to set up the floor kind of day trading.
Sure.
First of all, there is a lot of, there's a lot of excitement around being a day trader.
Correct.
It sounds very appealing.
Sexy.
You see these usually on Friday lottery, which people buy Thursday before the market closed,
right.
1 day to expiration.
A swing trade, right,
exactly.
Right. Whether they use options or equities.
Yeah, there's a screenshot which they did 1,000% on 20 cents.
And also you have guys on social media posting pictures of stacks of thousands riding on the back of their Bugatti that they made $1 million trading AMC.
Exactly.
It's not happening.
And that is how I want to set up the conversation.
Right.
Because And I've listened to your webinars, and I know kind of your philosophy. That's why I'm asking the question the way I'm asking. Let's break it down. It's an easy question. Is day trading easy to the common person?
It's not easy at all. It's simple, but it's not easy.
Great.
Okay, you are up against yourself. You're alone in a room, unless you're part of a trading private chat room. You're alone in your room with two different people sitting on your shoulder. The one that says, oh my God, I think the stock is going to go up. I hope the stock's going to go up. The fear of missing out. Everyone's running into it. I've got to go into that stock. And the other voice that's saying the discipline, consistency of a successful trader. Okay, 9 out of 10 day traders fail because of the basic psychology. They're not learning the rules. They do not have that toolkit. They never got the memo about the very specific rules of a successful day trader, and all the things that a unsuccessful trader do are all the same. Okay, so
let's try to break them down in 1, 2, 3. I think there are 5 or 9 or 8. I don't remember the number.
The 10 commandments of love. Yeah,
exactly, 10 commandments. And again, this is not only not financial advice. This is also not a speed course. So if you see this video and after this video you think that you're a day trader, that is not the message.
But
the message is that
go ahead.
Message is that we want to share.
As you will see in some of my webinars, with a few little facts, We can help you put the probability in your favor more
Exactly.
than you did before you met us to make money than lose money.
Exactly.
But it's not a get-rich-quick scheme. It's not something you can learn overnight. It's basically a 3 to 6 month learning curve if you're very specific. And look, you can learn from lots of people out there. There's Online Trading Academy. I won't mention any names. There are a lot of other people who charge tens of thousands of dollars to learn how to trade. I'm not going to mention any names. But then there's me and David Green. I'm here on the floor. People know who I am. They've seen me around for a long time. David Green has been my mentor and my teacher. He knows technical now. He's one of those teachers. Think about it. Remember, I'm sure hopefully everyone's gone to college who's on this call. There was that kind of a teacher who you didn't care what they were teaching. They were just somebody you wanted to be in that lecture room when they were talking because they were great. David Green is kind of that guy. But
So what are the commandments? So let's say I decided I want to dabble my feet in
day trading.
day trading.
Sure.
Now, first of all, I heard that 9 out of 10 are blowing up
Fail.
their accounts.
They fail straight up.
But I'm better than everyone.
Okay.
First of all,
You're the best.
I'm
Just
the best,
ask you.
right?
Just you'll tell me.
Exactly.
Okay, you're the greatest.
What are the things I need to be aware of?
Okay, so first of all, the stock market itself gives you this amazing tool called a stop order, right? We put it under the category or the heading of risk management, right? Am I willing to bet risk $50 to make $200? If any of you have ever gambled on a sport or any of you have gone to a casino, you're willing to bet $50 to make $200. I'm willing to do that all day long. Okay? Am I willing to risk $200 to make $50? That's a little different head. So the stock market gives you a thing called a stop order. Means that when you get into a trade, first of all, let's stop. The first thing is there's only one reason to get into a trade when it sets up technically. You need to ask yourself the question before you buy or short a stock, why am I doing it? Did Uncle Moshe tell me on the internet that I should buy it, right? Or am I trading on hope? I hope this stock goes up, or this stock can't go any lower. I've seen it. It's down 90%. It can't go lower. Or, wow, this stock is up 11 points. It can't go any higher. These are all the wrong reasons to get into a stock. If it sets up technically, that means that your charts using technical analysis tell you that the probability of it going up are 51% more than it is to go down. That's a plan. That's commandment number 1. Commandment number 2 is every time you get into a trade, on the long side or the short side, you use a stop order. What is a stop order? That means if I buy 100 shares of IBM or any stock, Snapchat, whatever it may be, XYZ. If I buy 100 shares of XYZ at $50, I'm going to put in a stop order at 49.5, down 1%. Which means if it goes against me, it doesn't mean I'm a bad trader. It doesn't mean I'm a loser. It means that the trade didn't work, right? So that's that 50 cents I'm talking about, the $50. If I buy 100 shares at $50, I put a stop order in at 49.5. For whatever reason it goes against me, it goes to 49.5, I'm out of the trade. I lost $50. Gesund to hate, it's all good. Don't worry about it. If it goes to 50.5, I sell half of my position. I need to know that instantly, if I'm making money, if I make 50 cents on the trade, I sell half of it. So I'm trading from a level of confidence. I made $50. If I lose $50, I'm out. I move on to the next opportunity. If I make $50, I take a profit on half of my trade. I raise that stop order up from 49.5 to $50, which is break even. So now I cannot lose money on the trade. What an amazing feeling. It's like, it's like going out on a date and you meet the girl and you sit down and she goes, I really think you're good looking. I like you. You got a little money in the bag here. It's already good. It looks like it's going to be a good date. If you make 50 cents on the first half of your trade, it looks like it's going to be a good trade. I raise my stop up to break even so I cannot turn a winning trade into a losing trade. What a great feeling.
It's an amazing feeling, but let me stop you for a second because that's where all the comments come in and say, but it's going up. Why am I taking half of the position out? It's going to go to the moon. I'm losing money.
No, okay.
I'm using the terminology.
No, but you're absolutely right. And that is the mentality of most people who lose money because they think, oh my God, it went to 50.5. It's going to the moon. I call Uncle Herbie on the internet. That guy on Reddit says it's going to the moon. I'm going to stay in it. I'm going to make $1 million. Wrong. Mistake. That's not the way a day trader works. The definition of a day trader is somebody who gets into a stock on the long or the short side, and you hit singles and doubles. You guys don't know much about American baseball. You can try and always hit a home run, but the better hitter, the better player, the consistent, disciplined player hits singles and doubles all the time and doesn't always swing for the fences. A successful day trader takes a profit when they can, not when they have to. They use a stop order to limit their risk, and they make money, and they trade and make singles and doubles along the way. That's it. If I watch the stock go from 50 to 51, I think I have diamond hands. I go to get myself a falafel in the backyard at the corner store. I come back. News came out. Jay Powell started talking, and the stock's trading at 46. I'm suddenly a loser. I buy more. It goes to 42. I buy more. It goes to 40. I can't take the pain anymore. I suddenly turned a profit of $100 into a loss of $4,000. I'm sick to my stomach. My wife or my partner is looking over me going, what are you doing? We were going to have nice presents here for Hanukkah. You lost all your friggin' money. And now I'm out on the corner just crying and yelling. I sell the stock at 40. It goes back up to 50. I'm sure you've all experienced it if you are trading the market. So I know you'd love to make $1 million on every trade. I know you want the stocks to go to the moon. Stocks don't go to the moon. It's a bad strategy. FOMO, hope, running into a stock when everyone else is getting into it, not using a stop order because somebody on the internet told you that the market makers are watching your stop order and it's an espionage conspiracy that the big guy's out to get you, and the suits and the market makers are trying to screw you. No, I've been working with them for years. They're trading billions of dollars every day. They're not worried about your 100 shares, 1,000 shares, 50,000 shares. Nothing against whoever you are, whatever your risk profile is. They're not worried about you. They're worried about their P&L. So that's three we've learning. Have a plan when you get into a stock. Have a stop order. And then when you get into it, start taking profits. That feeling of trading from a level of confidence where you now have made 50 cents and you cannot lose money on this trade. There you go. Those are right there. With those three commandments, you are already a better trader. You're already made some money.
Now, just to make it clear, when Peter says 50 cents, it's 50 cents multiplied by the amount of shares.
That you have.
It's not only 50 cents.
Exactly. Well, like I said, to be specific. No, it's fine. But if you buy 100 shares and you make 50 cents on that and you sell half your position, that's 50 shares at 50 cents is $25. Yeah. Well, I'll take $25. And then you raise your stop up to even, and it goes to 51. You sell 25% more, and you raise your stop up to lock in a half a penny profit. And then as it goes higher, you use what's called a trailing stop order or a bracket. And these are all things that you can learn in our course or anybody who teaches technical analysis. We didn't invent it. We're just good at what we do. And that's how you make the money all the way up until it changes. Okay, but you need to protect yourself. Like I said, I'm willing to risk 50 to make 250, but I'm not willing to risk 200 to make 50 because we've talked to people and I'll say to them, how you doing? Well, I made money 4 out of 5 trades. I said, oh, so you're up on the day. Well, no, I'm actually down $4,000. I said, well, how is that possible? Well, I made $100 on 4 trades. I was up 400, and on the 5th trade, I lost $5,000. Well, that's not a sustainable profit. That's not a sustainable trading strategy. Listen, I know everybody wants to just hit the ball out of the park, but in a market that goes up and down thousands of points every minute, every hour, every day, you cannot be risking, large sums of money all the time because you will blow yourselves up. Take it from old Einstein. That's just the way it is.
And two more questions, and one related to that, and the other one is more general. Related to that, one of the things I love what you and your partner said is, once you've reached your daily target, you didn't want to mention that as the fourth commandment.
4.
Exactly. What do you do? Because when you start your day, if you don't set targets, then everything's a target, right? You want to make $1 million.
Correct.
But when you set a target, let's say $200, $300, it doesn't matter the target. Let's say I've reached it. It only took me 30 minutes or an hour or 2 hours.
Okay.
What happens then? Because the market's going up. The market keeps on going up.
I gotta make more.
Exactly.
Think about the guy who goes. Look, there are 2 people who go to the casino, who go to Atlantic City. There's one guy who goes to the casino with $500. He sets himself a goal. That means he's going to play as long as it takes an hour or 4 hours to make $500. If he's up 1,000, 500 what he brought, 500 what he make. He's going out. He's going to go to Ruth Chris, get a nice steak, and spend time with his family. There's the other guy who has no plan. He goes in with $500. He's up $1,500. He thinks he's got diamond hands. He keeps playing and playing and playing.
Goes all in.
He goes all in for the whole night. The other guy made his $500 target goal for the day. He goes out. He's already having dinner with his family and relaxing and is spending time, quality time, which is something you cannot cut back. The other guy was up $2,000, and by the end of the evening, he's down $3,000. The discipline and consistency, these are the two key words here, okay, that prevent people from losing money or turning a winning day into a losing day. If I'm a 100-share trader, and this is all stuff I learned from David Green, I'm telling you, he's my mentor and my teacher. I don't do collaborations, but I'm doing one with him because he's a great technician and a teacher. If I'm a 100-share trader, I want to make $100 a day. If I hit my goal, I turn the machine off and go home. If it happens by 9:45, beautiful. I got a day to be at the beach relaxing, drinking Coco Locos with the family. If it takes me all day, that's fine also.
And that is
it's a really hard discipline. We don't have someone sitting on your shoulder. The one guy on your shoulder, you remember the old guy, the Flintstones used to have a guy named Kazoo. He'd sit on your shoulder. You got more. You can do more. You got to make $100. You can make $3,000. That guy is sitting on your shoulder, chattering in your ear. Stay, keep trading. You can make more money. And the one who's not on your shoulder is the one who says, you hit your goal, turn the machine off. This is the best it's going to get. How many times, if you guys are and girls are traders, you are up $300 and you said, I got to just get, you know what, I'm doing great, I got to admit, and you'll end up by the end of the day, you're down 4,000 or you're down 1,000. You turned a winning day into a losing day. You should have turned the machine off at up 300, but you didn't. So we don't want anyone ever to turn a winning day into a losing day. Have a goal on target on how much you want to make in your day. When you hit that goal, turn the machine off and go home, go to the beach and chill. That's commandment number 5, I believe it is.
Yeah.
Okay? Then the last one is, no, there's more of them, but this is the last one I'll give you this time, is if you're trading and you're just having a bad day and you have 3 losing trades, doesn't make you a loser, doesn't make you a bad trader. You will come back from a losing day. You will come back from a losing week, but not if you lose thousands and thousands of dollars. If you have 3 losing trades, you turn the machine off, it's a bad day. That's it. It's a bad day. You're not a loser. You're not a bad trader. You're just having a bad day. The market could be going against you. Maybe the technicals aren't working today. We have losing trades all the time. We have losing days. We've very rarely had a losing week. 3 losing trades, turn the machine off and go home. Get out of your room. Go to the beach. Go to a restaurant. Chill out. Shake it off. I know it's not going to happen, okay? But if you're trading with these strategies and you lost 100, you're down $300, you will come back from it. But if you revenge trade, if I'm down 300 and you start what most unsuccessful traders do, they go all in. I'm going to start trading bigger size. I'm not going to use my stop orders, and I'm going to revenge trade my way to a profit. What happens to those guys and girls? 8 out of 10 times is they end up losing large sums of money. Revenge trading and not turning the machine off when you're having a bad day is an absolute recipe for a disaster. That's the 5 commandments. David Green's 5 commandments of love and trading, and we got more next time.
Peter, that was amazing.
Thank you.
Now, I'm looking here at all the different screens, and you can probably shed some light. What are the people here looking at? So I'm gonna take a video later on. I'm gonna add it to the afterwards. I'm not gonna move the camera now. What are all the? We talk technicals,
right?
And there are, I think, last I checked, between 1,000 to 3,000 different indicators that you can add on a chart.
Really? Okay, that's
like
crazy.
That.
Yeah, that's why I say it's really. Try and keep your charts simple. You don't want your charts to look like air traffic control in 9/11.
Exactly. So so people here, are they even looking at charts, or are they just
absolutely
getting the phone, buy me 100 shares of Apple?
No. Look, so orders from the floor of the stock exchange, no orders are generated down here. Okay, we are not allowed to do that. I cannot walk into a stock and say, I want to buy. First of all, I cannot trade for myself. Secondly, I cannot generate an order on the floor. Like I walk by, I see a crowd, there's a bunch of people buying, and I say, oh, I'm going to buy 1,000 shares. It looks like it's going up. That doesn't happen. That is illegal. It's not what's happening. Everybody down here is a different axe to grind. Some people are doing institutional business. Some people are doing trading. Some people are doing hedge fund trading and whatnot. Some are trading against the imbalances on the open and the close. Everybody's looking for an edge, an opportunity, and trying to make some money for their customer. Okay? Orders are always generated from upstairs. Okay? The orders, you've got, think about it. Somebody's got an institution's got a fund, they're trading some money, they have their morning meeting, the portfolio managers decide we're going to buy 100,000 shares of A and B and C. They send the orders down, and then the brokers on the floor with all these things you're talking about, they may be using a Bloomberg, they may be using technical analysis, they may be sort of seeing who the buyers are, who the sellers are, where the bodies are buried, how much is that institution buying, why is he buying it, what's the news out, what's going on in the war, what's Jay Powell saying, and all these different indicators. Look, you can fill your chart with Fibonacci, Bollinger Bands, pivot points, EMAs, regular moving averages, RSIs, overbought, oversold, support, resistance, all of these things, and they're all great, right? The different, even with EMAs, some we use 9, 15, 30, 65, 200. Some people use all different ones, right? Use whatever works for you. We didn't invent this stuff. We're just trying to be disciplined and use what works for us. Okay, you can use last week's high, last night's low. There's so many different indicators. We try and keep it simple. Okay, this isn't easy, but it is simple. The more simple you make it, the better it is for you. Everyone down here uses different indicators, what they've worked out with their customers, what they like to do. We've got a guy in the company I work for that's super aggressive. He's checking the Bloomberg, who's been buying over the last week, where the sellers are, who's got the big positions, what are the hedge funds doing. That's what he does. Some people are looking at technicals and looking at moving averages. Some are just on the phone with their customers trying to see what does the customer want to do, because all that analysis is being done upstairs by some people way smarter than me and them, right? I know I look like Einstein. I'm not that friggin' smart, but I'm here to execute and open up the lines of communication between me and the customers, with me and information. Information is gold, right? Information is gold. What do the earnings look like? And I don't trade proactively on earnings. What do the earnings look like? What is the guidance? What are the products in the pipeline, right? What are the technicals? What are the fundamentals? What's going on in oil? What's going on in the ETFs? Who's buying this? Who's buying that? These are all important things. But if you're that's from the investment point of view. That's what's going on right here. Some people are traders. Some people are trading for long-term investments. But at the end of the day, a day trader's job is to make small bits of money over and over again so that they're green at the end of a day, more green at the end of a week, and more green at the end of the month and the year. And that's what they do. Hitting singles and doubles, that's it. And never losing a large sum of money.
Peter, thank you very much.
My pleasure.
Thank you. And I'll add
everybody.
everything to the description. Let's twist it around. This is how it looks from the balcony. Yes, you can see all the trading floor. You can see the charts. There's the opening bell.
There are the indicators that we use: volume, up and down, utilities, transports. Right? You've got gold, you've got oil, you've got FANG, you've got the dollar. Right? You've got the ticks up and down in gold, and you've got all this. This is an amazing room built in 1903. Okay.
This is still from 1903.
The building was built in 1903.
Amazing. All the computers. You see, guys, you thought computers were invented in
1903.
In 1903,
Right.
exactly.
That's the only difference from 1903 is the technology.
Here's the bell. Peter, again, thank you very much.
My pleasure. Bye, guys.
Bye-bye.
Shalom, shalom. Boom.